This recording covers the beginning of Chapter 3, so terminology and the accounting equation. This is basically the overview of the chapter. You are responsible for everything in this chapter. Accounting information systems, it's just a system that collects and processes the transaction data. And then it will, the processing is putting it into the financial statements, and then that information in the financial statements is disseminated or given out. Now, it used to all be done on paper, but now it's done mostly in computers. They have this system so that they can answer questions about what's going on in the business. So different types of questions that would be asked are listed here. And I mean, it covers a broad list of information. Okay, basic terminology. An event, this is the economic activity that's taking place that is we're trying to capture. A transaction is a type of an event. An account is the name of a bucket, basically, where you're collecting certain pieces of information. A real account, these are usually balance sheet accounts. Real accounts don't get set to zero at the end of a period. A nominal account, these are mostly income statement accounts, and we'll talk about those again. We're going to go through the ledger, journal, and posting. We will spend some time on adjusting entries and closing entries. Debits and credits. So you need to know your debits and credits for this to work. Debit simply means left. Credit simply means right. What we're doing is putting counts in each side, the debit side and the credit side, and they have to balance when everything is done. So it's a double entry accounting system, and the beauty of that is that it does reflect whether or not it is in balance, so you know if you miss something. Again, so debit is left, so that's this half of the T account. Credit is right. When you have dollar amounts in here, you add the debit side, subtract the credit side from the debit side. If you have a debit, it's going to have a debit balance. If the credits are bigger than the debits, you're going to have a credit balance. You need to know the normal balance of accounts. So assets and expenses normally have a debit balance. Liabilities, stockholders' equity, and revenue normally have a credit balance. This is the accounting equation, and you need to always know that. And this is showing us the balance. This is, in effect, our T account here. The assets increase with debits. The liabilities and equity increase with credits generally. The income statement here, this is capturing the activity during a period of time, and that income statement is part of the equity account. All right, so assets will go up with the debit, and expenses will go up with the debit, so increase the amount. Liabilities, equity, and revenue all have normal credit balances, so when you do a debit to those accounts, it decreases the value of it. Assets normally have a debit balance, so they decrease with the credit. Expenses decrease with the credit, but liabilities, equity, and revenue all increase with credits. Here's another way to look at it. So they're just showing us that assets, each asset will have its own account. You'll have a debit side and a credit side that you're keeping track of. Same thing with the liabilities. Now in the shareholders' equity, what you're seeing here is because dividends have a minus, dividends are flipped from the rest of the equities. And because expenses are a minus, expenses are flipped from the rest of equity. So common stock, retained earnings, and revenues all go increase with credits, but dividends and expenses decrease with credits because they're subtracted when you're doing the equation. All right, we're going to do some practice on this. So this is our event, and we're going to record it as a transaction. So the owners have invested $40,000 in exchange for common stock. So the owners have put an asset into the business, so that's here, in exchange for equity ownership in the business. So the asset has a debit, the stockholders' equity has a credit. So you can see that's $40,000 in the assets, $40,000 in the liabilities and stockholders' equity, and our debits are also equal to our credits. So dispersing $600 cash for secretarial wages, so the cash is decreased, and this would be an expense. It's an asset that has been consumed in the course of doing business. So an expense, again, is a negative stockholders' equity. So you'll see the negative stockholders' equity. You'll see that assets are going to have a credit because their normal balance is a debit, and this is a minus, so it's a credit. Stockholders' equity is going to get a debit. The normal stockholders' equity is a credit, and because this is a minus, it would have to be a debit. Purchase office equipment priced at $5,200, giving a promissory note. So that's the definition of a liability because we have an obligation to give up assets in the future or resources in the future. So assets are going to go up by the value of the equipment because we now own the equipment. Liabilities will increase by the value of the promissory note. And again, assets increase with debits, liabilities increase with credits. Receive $4,000 cash for services performed. So cash is an asset and it's increasing. And this would be revenue because we perform services. So the stockholders' equity increases. So the revenue is an increase to stockholders' equity. So assets will be increased with the debit. Stockholders' equity increases with the credit. Pay off a short-term liabilities, so the cash is going to go down, so it's a decrease to an asset. The liabilities are going to go down because we're paying them off. So we had a balance of $7,000, now we have a balance of $0. And again, our assets normally have a debit, so a subtraction would be a credit. Our liabilities normally have a credit, so a subtraction would be a debit. Declared cash dividend, so a dividend is a distribution of owner's equity. We have just declared it. We haven't paid it yet, so it's going to create a liability. That's why you have the $5,000 here. And it's decreasing stockholders' equity because you're taking it out of the company and returning it to the stockholders. So liabilities are normally increased with the credit, and it is increasing, so you're going to credit. Stockholders' equity, we said we're decreasing it, so that would be a debit. Convert a long-term liability into common stock. So basically, we are decreasing the liabilities and increasing the common stock. And again, the liabilities, because they're normally a credit and this is negative, that would be a debit. Stockholders' equity increases with credit. You're paying cash for a delivery van. So cash is going down. So it's a decrease to an asset. But we're receiving an asset in exchange for it. So what you see is we have an up and a down in the asset. So there's no net change in assets. Ownership structure, we deal with two different types. We mostly will deal with corporations after we get out of Chapter 1 and 2. The other thing could be a partnership or a proprietorship. And the only difference is what shows in the owner's equity section. So under a partnership or a proprietorship, they'll have owner's capital accounts and owner's drawing accounts. In a corporation, we're going to have common stock, paid in capital in excess of par. Sometimes they call it additional paid in capital. You'll have dividends accounts and you'll have a retained earnings account. So you can tell if this is a corporation or a not a corporate structure by looking at the owner's equity section.